Okay, we're going to try this. My microphone seems to be doing something screwy this morning, but here we are. Anyway, we're going to look at the declining balance method of depreciation. There are a couple of differences to note. One, you can calculate the depreciation. You calculate the depreciation on the cost, not on the depreciable value, like you do with the other two methods that we looked at. We've looked at straight line, of course, and the units of production. You can only take depreciation equal to the depreciable value. Even though you're computing depreciation based on the cost, you can still only depreciate the book value of the asset down to the salvage value, meaning you can only take depreciation equal to the amount of the depreciable value of the asset. And finally, it can be double declining balance, it can be triple declining balance, it can be 150% declining balance. Get rid of a couple of apps running. Here's the way we do it. We have the cost of the asset. We have the salvage value. Subtract the salvage value from the cost to get the depreciable value. Then you have the useful life in years. You divide the depreciable value by the useful life and you get the annual straight line depreciation. Now let's divide that that depreciable value. Let's divide the straight line depreciation by the depreciable value to get the straight line rate. And then if it's double declining balance, we would multiply that by 2 to get the double declining balance rate. And it could be 150% declining balance, 300% declining balance, etc. Double declining balance seems to be the most common. So let's grab the instructions and look at those. All right, we have $145,000 of the cost. The salvage value is still $25,000, leaving a depreciable value of $120,000. Useful life is 5 years. Annual depreciation, straight line, is $24,000. 120 divided by 5. So the straight line rate, if you divide 24,000 by 120,000, or the annual straight line depreciation by the depreciable value, you get 20%. And since this is double declining balance, the double declining balance rate would be twice that, or 40%. So here's our schedule of our depreciation schedule. We start out with the the beginning book value, which is equal to the cost, salvage value, depreciable value, the rate. Then we get to annual depreciation. You notice it says A times D, the beginning book value times D. We're not looking at depreciable value. We're looking at the beginning book value times the rate. So the first year, $58,000 in depreciation. Let's just scroll up to straight line, and it was 24,000 for our first year's depreciation, 20% of the depreciable value. We're using 40% of the beginning book value, which is cost at this point. So $58,000 worth of depreciation the first year, leaving an ending book value that year of $87,000. We use that $87,000 to do the computation for the next year. So 40% of $87,000 gives us $34,000 the second year, and given ending book value is $52,200. Then we use that same number, $52,200 times 40%, to get the depreciation in the third year. And in the fourth year, you notice we did something. We went over the amount of depreciation we could take. Accumulated depreciation can never be more than the depreciable value, and the ending book value can never be less than the salvage value. So when we get to this point, when we get to a year, and it could be the last year or it could be the next to last year. This thing goes so fast, sometimes it can be the next to last year. We'll just make sure that we don't go over that. So we get the ending book value last year, subtract from it the salvage value, and we just force that number to be the depreciation this year. And we don't even need the fifth year. So even though it's a 5-year life, double declining balance, if it's just used all the way through, will give us, will end up depreciating the asset in 4 years in this case. Every case is different. But that last year's depreciation in double declining balance is always going to be forced to the number that we need. Now the depreciation schedule we just did is for an asset purchased on January the 1st, 2019. But let's look at it when the asset is purchased on October the 1st, 2019. In this case, you'll notice that the depreciation the first year is going to be some portion of a full year's depreciation, and it happens to be 3/12. So 58,000 is the depreciation for 1 year, times 3 divided by 12, 14,500, 3/12. And then we just continue working like we normally do. We have $130,000 at the end of the year as the ending book value, cost minus accumulated depreciation. We start with that for the second year, times 40%. So in the second year, which is a full year's depreciation, we take 52,200, and that's our ending, 78,300 is our ending book value. Use that 78,300 to come up with our depreciation this year, 40% times that, and we end up in the fourth year getting up to getting down to $28,000 in the book value, or up to 116,000 and change in the accumulated depreciation. And you notice if we let the equations work, then we'll be over depreciated the next year. We'll take $128,000 worth of depreciation total, 8,000 and some odd dollars more than the depreciable value, and we'll be under, by the same amount, under the salvage value. So again, that last year, we just take the ending book value the year before and subtract from it the salvage value to figure out what the difference is, and that we force that to be our depreciation for the final year. Again, when you're doing double declining balance or any declining balance calculation, that last year is going to have to be forced. It won't work out because we're computing depreciation based on the beginning book value each year, but we're not counting this salvage value. That's why at the end the calculation messes up. I don't like that $1 sitting there. Anyway, so at the end we end up with accumulated depreciation equal to the depreciable value and the ending book value equal to the salvage value.